Welcome back to the deep dive. Look, if you were watching the markets at all this week, you know it was all about one thing, the Fed.
Absolutely. That FOMC meeting on September 18th, the anticipation was
You
huge.
could feel it, right? Charts were jumpy, everyone holding their breath. Were we getting a green light from Powell for a real rally, or was this just, more smoke and mirrors?
And that's exactly what we're digging into today. We've pulled together the reports, looked at the macro reaction, and really zeroed in on Powell's language. What's it actually signal for the rest of the year?
Okay.
So we'll break down what the Fed did, how that connects to the big institutional moves we're seeing, and then, get into some specific altcoins that popped right after.
Perfect. Separating the signal from the noise. Let's do it. So the main event.
Right.
The rate decision itself. We kind of knew it was coming.
Yeah, no surprises there. The Fed delivered that 0.25% cut, just as expected.
Right.
Brings the new target range down to 4% to 4.25%. But honestly, the market barely blinked at the number itself.
Right, because the real action is always the press conference afterwards. That's where the volatility kicks in.
Exactly. Powell's presser. That was the driver.
So what was the key takeaway this time? What nuance moved the needle?
Well, analysts are calling it a really mixed stance, kind of transitional. On one side, his language did seem to soften a bit, shifting away from that really strong caution we heard before, more neutral, maybe.
Okay. The hint the market wanted, that the tightening's really over and cuts are starting.
Sort of. That's the subtle signal risk assets we're listening for. But there's always a but with Powell, isn't there?
Always. He didn't just open the floodgates, I assume.
No, definitely not. He immediately flagged inflation concerns again, said the Fed's watching closely for any rebound. And he specifically mentioned global stuff, like tariffs, adding uncertainty that could push costs up.
So giving a little bit with the cut, but holding back with the inflation warnings. What was the main point that keeps things uncertain then?
Data dependency. That was crucial. He hammered home that there was no signal of more cuts coming this year. None. Right.
Future moves, purely based on the incoming data jobs, inflation numbers, growth, no preset plan.
Okay, so for listeners trying to plan, what does that mean? Data dependency usually equals more volatility, right? Ambiguity isn't great for stability.
Absolutely. And we saw that immediately. Sharp swings as the market tried to figure out the mixed messages. But ultimately, risk assets, crypto included, did manage to find their footing and push higher.
So the takeaway is,
the market split. You've got the bulls saying, great, the cutting cycle has started. And then you have the cautious crowd pointing out the Fed could easily slam the brakes if inflation picks up. That division means we should probably expect more sharp, maybe unpredictable moves, even if the general trend feels like it's upwards for now.
Okay, that makes sense. And this is where we connect the macro dots to the crypto structure itself. Analysts are saying this cut, even if small, really kicks off the easing cycle. What's fundamentally different for something like Bitcoin this time around compared to past cycles? Right, so the bullish case is pretty clear. Historically, lower rates tend to weaken the dollar, push money out of bonds and into scarce stuff like Bitcoin. But the big structural shift now, institutionalization.
The ETF effect.
Exactly. Big players, even names like Goldman Sachs, are now major holders through these Bitcoin ETFs.
And they call that a stronger floor for prices.
Yeah.
Explain that a bit more for folks maybe not deep in market structure. What does a stronger floor actually mean in practice?
It means the demand is just stickier, more reliable. In past cycles, like 2017 or even 2021, it was heavily driven by retail speculation, which can evaporate quickly,
Yeah, very sensitive to headlines.
Right. Now, when prices dip, you've got these large regulated funds potentially programmed to buy in to maintain their allocations. It's a steadier flow of capital, less prone to panic selling. It changes the psychology.
Okay, that sounds pretty bullish. We're seeing targets like $150K, $200 being mentioned if this keeps up. But let me push back on the risk side. If Bitcoin's now an institutional darling, moving with ETFs, doesn't that mean it acts more like a tech stock? Doesn't that kill the old uncorrelated hedge narrative?
That's the million-dollar question, isn't it? And yes, that correlation is the major risk everyone points to now. Bitcoin has evolved. It definitely trades like a high beta growth asset these days.
So if the NASDAQ drops 15%?
Bitcoin's probably going down just as hard, maybe harder. Yeah. And the other risk is stagflation. If inflation stays high but growth stalls and the Fed is stuck, that could be really bad for risk assets, including crypto, because it's tied to that risk on sentiment, not yet proven as a reliable stagflation hedge.
So we gain institutional stability, but take on more macro correlation. It's a trade-off. Okay, this flows nicely into the altcoin picture. Bitcoin usually leads the charge. If BTC holds this uptrend, what does that mean for alts heading into Q4?
potentially a significant tailwind. And it's not just sentiment. There are structural things happening too, like the reports are highlighting these potential generic listing standards from the SEC.
Sounds technical, but I gather it's a big deal. Why do those standards matter for getting ETFs for coins like Ether or Solana approved faster?
It's basically about creating a template. Instead of the SEC needing to approve every single ETF application from scratch, which is slow and unpredictable.
Yeah, painful.
Right. These generic standards could mean if an asset already has a regulated futures market, like on Coinbase, the path to getting a spot ETF approved becomes much, much easier. It's like a fast track.
So it shortcuts the process for coins with existing futures, like ETH, SOL, ADA, XRP.
Exactly those. It could open the floodgates for easier institutional buying of those spot assets, potentially huge for liquidity down the line.
Okay, let's get specific then. Because the market didn't wait. Avalanche, AVAX, seemed to surge right after the FOMC. Why was it such a strong mover?
AVX was like the perfect storm of good news hitting all at once. It wasn't just riding the macro wave.
What were the catalysts?
3 big ones stacked up. First, the AVX Foundation dropped a huge announcement, a $1 billion Treasury Development Fund, massive ecosystem boost.
$1 billion, wow. Okay.
Second, you had Bitwise file for a new Avalanche ETF right around the same time.
ETF filing, okay. And the third one sounded pretty significant, involving South Korea.
Yes, the proof of concept stage of South Korea's first stablecoin pegged to the won, KRW1, built on Avalanche.
Okay, a stablecoin PHUC with reserves held at Woori Bank, a major Korean bank. That sounds like serious validation.
It really is. Even at the PHUC stage, having a major bank like Woori involved lends huge credibility. So you combine $1 billion in funding, an ETF filing buzz, and this kind of national level stablecoin project that's powerful momentum. Makes AVAX definitely one to watch.
But let's be a little skeptical. Is a PPC really a signal or just them showing off tech that might not actually get fully rolled out?
That's fair nuance, but I think for investors, the signal is Woori Bank's involvement. They wouldn't likely attach their name if the tech wasn't solid or couldn't potentially meet regulatory standards down the line. It shows the network is fit for purpose, That's a big long-term validator, even if the actual stablecoin isn't fully live yet.
Got it. Okay, let's switch gears to a more cautious tale. HYPE. Reports mention strong fundamentals, but a tricky situation with a big seller. What's going on there?
Yeah, this is a fascinating whale watching situation. There's a major holder, someone controlling nearly $300 million worth of HYPE tokens, who's been actively selling.
Wow, $300 million, just taking profits.
Apparently not just cashing out. The analysis suggests they've been rotating that capital directly into a different project, a new decentralized exchange called Astrodex.
Rotating, so selling HYPE to buy Astrodex.
Exactly. It looks like a big directional bet. Traders are describing Astrodex as this new decentralized perpetuals exchange, supposedly with strong backing from Binance and CZ.
Interesting. So the implication is this whale thinks Astrodex is the next big narrative, maybe Binance's answer in the decentralized perp space.
That seems to be the read. And when you have a $300 million rotation like that, it creates serious selling pressure on HYPE specifically, regardless of its own fundamentals. Makes the immediate price action really challenging for HYPE holders.
Looking quickly at the other majors post-FOMC, what's the technical vibe for ETH, XRP, SOL? Any key levels or indicators people should watch?
Yeah, the 20-day EMA, that's the exponential moving average, is a good one to track for the short to medium trend.
Right, staying above it is healthy.
Exactly. ETH is kind of testing its ability to break out cleanly after bouncing near that 20-day EMA. XRP has a similar look. If it keeps pushing, the next resistance zones people are eyeing are around $3.40, maybe then $4.
And Solana? Still looking strong.
SOL continues to show relative strength, good institutional flows apparently. The general view seems to be that dips towards that 20-day EMA are buying opportunities within the uptrend, not danger signs.
But overall caution still applies.
Definitely. Even with prices grinding up, sentiment indicators aren't exactly euphoric, still showing neutral, which tells you there's still a lot of caution and awareness of those macro risks we talked about.
Right. Okay, that leads us into the broader industry stuff, Section 4. This feels like the really important long-term picture. Let's start with new infrastructure. Plasma's mainnet launch, backed by Bitfinex. What's the significance there?
This looks like a pretty big deal for infrastructure. Plasma is set to go live around September 25th, and they're launching with, get this, $2 billion in stablecoin liquidity and over 100 DeFi integrations lined up.
$2 billion liquidity at launch. Okay, that's serious scale.
Yeah, it's not just another layer 2. This seems like a major push with Bitfinex support to build faster, cheaper rails for DeFi. They're rolling out their XPL token alongside it too. It signals that move towards high throughput, more integrated systems.
And right alongside that innovation, we see the regulation train picking up speed, especially in Europe with MiCA. What about this Kraken and Legion partnership for MiCA-compliant token sales?
This is all about professionalizing how new crypto assets come to market. MiCA is becoming the standard in Europe.
Right, the markets in crypto assets regulation.
So Kraken and Legion are basically teaming up to offer token sales that meet those MiCA standards. Think IPO-level diligence and disclosure, but with the crypto benefit of immediate listing and liquidity on Kraken.
So bridging traditional finance standards with crypto speed.
Exactly, creating regulated, trusted ways for new projects to launch and for institutions to participate. And speaking of institutions, look at tokenized securities. This partnership between DBS, Digital Exchange, Franklin Templeton, and Ripple.
DBS is a huge bank in Asia. Why are they using Ripple's stablecoin, RLUSD, for this?
Well, that's the validation signal, isn't it? They plan to trade Franklin Templeton's tokenized money market fund, a very traditional asset, directly against Ripple's RLUSD stablecoin on the DBS exchange.
Okay, so using RLUSD as the settlement layer for tokenized traditional assets.
Yes. It shows institutions are starting to trust and use specific digital rails like RLUSD for real-world trading, not just experiments. It's moving tokenized securities beyond just proof of concepts into actual live trading of major funds, integrating these things.
Okay, so let's try and wrap this all up for you, the listener. It feels like the main takeaway post-FOMC is this tension, right?
Mm-hmm.
On one hand, the macro tide is turning risk on, because the Fed has clearly started cutting rates.
Yeah, that fuels the classic crypto sequence. Bitcoin leads, strong alts like AVAX follow when they have their own catalysts firing.
And it's a big but.
Yeah.
That the enthusiasm is constantly bumping up against high volatility and those big macro worries, inflation possibly coming back, and crypto acting like a tech stock when the stock market itself looks fragile.
Exactly. So while traders are watching charts and EMAs, the underlying story is this rapid maturation of the industry's infrastructure.
Right. We talked about MiCA compliance, making things more professional, huge development funds like avalanches, institutional stablecoins being used by banks like DBS, and new DeFi platforms like Astrodex, attracting massive capital rotations.
It really does feel like we're watching that shift happen in real time, moving away from just pure hype and speculation.
Like the old days.
Towards a more formal, compliant, integrated role for digital assets within the wider financial system. And maybe that integration is what ultimately underpins those bigger long-term price targets.
So maybe the final thought for you to chew on is this. Given this shift we're seeing towards both serious compliance and innovative DeFi, where will the big money flow most sustainably over the next, say, 6 months?
Is it going into the pure cutting-edge DeFi plays like that rotation into Astrodex suggests? Or is it the more formal, institutionally backed tokenization like the DBS and Franklin Templeton initiative?
Or maybe both. Where's the biggest impact likely to be felt?
That's the key question for the market now. Definitely something to keep in mind as you navigate things until the next deep dive.